wherever you are and whatever time you're listening to this. Good morning, good afternoon, and good evening. This is the Market Color Podcast, where we keep you posted on the latest developments in the financial markets. And this is with a view to helping you better understand how the markets operate so that you can make informed investment decisions. And we do that by first giving you a broad overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment, where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 192, and in this episode we're reviewing the performance of the financial markets during the 52nd and the last full week of 2025, and that is from Monday the 22nd to Friday the 26th of December. And without further ado, this is your host, Jamhuri, and together, let's dive right in. We kick it off in the United States, where the US economy grew at a much faster than expected pace in the third quarter, boosted by strong consumer spending. The GDP report was originally scheduled for release on the 30th of October, but was delayed by the US government shutdown. According to the report that was released by the Commerce Department on Tuesday, the gross domestic product, which measures the total value of goods and services produced within the US economy, this showed a growth of 4.3% in the period between July and September, which was much higher than the 3.2% growth that economists had projected. Consumer spending, which accounts for about 70% of the US's gross domestic product, expanded by 3.5% in the third quarter compared to 2.5% in the second quarter, thanks largely to increased spending on healthcare and international travel. The stronger than expected growth further complicates the current picture of the US economy, which also continues to show declining consumer sentiment and a higher unemployment rate. The spike in consumer spending is in sharp contrast to consumer sentiment, which fell for the fifth consecutive month in November. This divergence in data could be the result of what is referred to as a K-shaped economy. And this happens when wealthier consumers are able to continue spending as their stock portfolios increase in value, whilst middle and low-income consumers have to tighten their budgets because of rising prices. On Wall Street this past week, the S&P 500 hit a new high on Friday and posted weekly gains as traders came back from the Christmas holiday. According to a market strategist, there is a move by investors to diversify their portfolios, and this broadening approach could be the trade in play for the new year. This was evidenced by the new record high hit by the S&P 500, which surprisingly was not just driven by the technology sector, but rather by financials and industrials, which are two key sectors of the U.S. economy. For the week, the broad market index, that is S&P 500, gained by 1.4% to close at 6,929, whilst the Dow Jones Industrial Average rose by more than 1% before settling at 48,710, and the tech-heavy Nasdaq Composite was also up by more than 1% as it came to a close at 23,593. In the government bond market, the yield on the benchmark 10-year Treasury bond was little changed on Friday as traders came back from the Christmas holiday to wrap up a week that revealed strong economic data. Data from the Commerce Department showed that the U.S. economy grew by 4.3% in the third quarter of 2025, which was the fastest pace of growth in the past 2 years. According to a market analyst, the U.S. economy is in good shape, and with strong economic growth and a relatively stable inflation, it is highly unlikely that the 10-year yield will move much lower. That said, the market is currently pricing in at least 2 rate cuts in 2026, but that is subject to change as the ultimate decision will be made by the Federal Reserve, which will be heavily influenced by the latest economic data. In response, the yield on the short-dated 2-year Treasury note shed more than 2 basis points to trade at 3.48%, whilst the yield on the 10-year Treasury bond fell by less than 1 basis point to close at 4.13%. And just for your information, 1 basis point is equal to 0.01%, and bond yields and prices move in opposite directions, which means that as interest rates rise, bond prices fall, and vice versa. In the commodity markets, the price of crude oil fell more than $1 a barrel on Friday as investors weighed on a looming global supply glut and a reduced war risk premium amid hopes of a peace deal between Russia and Ukraine. Investors are watching for developments in the Russia-Ukraine peace process and the possible impact on future oil prices, given that a peace agreement could lead to the removal of sanctions against Russia's oil sector. And on the supply side, according to figures from the International Energy Agency, global oil supply in 2026 is expected to exceed demand by about 3.8 million barrels per day. This oversupply continues to weigh down on the price of crude, which is on track for its steepest annual decline since 2020. It is therefore no surprise that on a year-to-date basis, both benchmarks, that is Brent and WTI, are down by 18% and 20% respectively. And as the markets closed on Friday, the price of Brent crude was trading at $61.21 a barrel, whilst the price of West Texas Intermediate crude was recorded at $57.30 per barrel. In the precious metals market, silver broke above $77 for the first time on Friday, whilst gold hit a new record high as both metals were lifted by expectations that the Federal Reserve will continue cutting interest rates, as well as geopolitical tensions that have fueled the demand for safe haven assets. The markets are projecting 2 rate cuts in 2026 amid speculation that President Trump could name a dovish Fed chairman, which reinforces expectations for a more accommodative monetary policy. On a year-to-date basis, the price of spot silver has risen by 167%, driven by supply deficits and strong investment flows, and was up by 7% on Friday before closing at $77.12 per ounce. Meanwhile, gold remains on track for its strongest annual gain since 1979, driven by the Fed's easing of policy, as well as central bank purchases, ETF flows, and the ongoing trend towards de-dollarization. In response to the foregoing, the price of spot gold has increased by about 70% so far this year and was up by about 1% on Friday before settling at $4,529 per ounce. We now change scene to the Kenyan financial market. And we start by looking at the domestic foreign exchange market, where the Kenya shilling continues to trade within a narrow range versus the US dollar. And according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at a rate of 129 shillings flat, compared to a rate of 128.94 that was recorded the previous week. Meanwhile, the sterling pound was priced at 174.32 and the euro was valued at 152.13. And on the regional front, one Kenya shilling was changing hands for 28.01 Ugandan shillings and 19.07 Tanzanian shillings, and to the Rwandese franc, it was posted at 11.29. The IMF has previously raised concerns about the stability of the Kenya shilling, but the central bank insists that it continues to adopt a floating exchange rate policy. However, the data tells a different story, as the dollar shilling rate has been stuck at between 129 to 130 shillings over the past 2 years, and now appears to be operating like a fixed exchange rate. Given this previous price action and barring any external shocks to the domestic economy, we expect the shilling to remain range-bound in the short term. However, in the longer term, the outlook for the Kenya shilling still remains negative, and this is evidenced by the country's excessive national debt, which now stands at about 70% of the country's gross domestic product and consumes about 60% of total revenue collections. On foreign exchange reserves, during the past week, Kenya's usable foreign exchange reserves increased marginally by just $35 million for a grand total of $12.16 billion, which is equivalent to 5.3 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Despite this relatively massive position, Kenya's foreign exchange reserves remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports, and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default. In the money markets, during the past week, the interbank market was sufficiently liquid and was also backed up by the central bank through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and interest rates in the interbank market. The overnight interbank rate, which is now referred to as a Kenya shilling overnight interbank average, aka KESONIA, This is the rate that banks use to lend to each other and is now the new reference rate for lending transactions by commercial banks. The overnight interbank rate ticked up slightly from 8.98% recorded the previous week to 9.01%, which remains pretty much in line with the new central bank rate at 9% flat. Meanwhile, the excess reserves held by commercial banks in relation to the cash reserve ratio that is currently set at 3.25%, this stood at 16.5 billion shillings. For your information, the cash reserve ratio is a statutory requirement that specifies a percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Wednesday, the 24th of December, and the central bank received bids totaling to 5.4 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of just 22%. The central bank ended up accepting almost the entire amount, and the results of the auction were as follows. The 91-day rate declined by about 5 basis points to settle at 7.72%, whilst the 182-day rate continued to hold steady at 7.80%, and the 364-day rate dipped by more than 1 basis point to average out at 9.21%. At the Nairobi Securities Exchange, during the past week, the equities market recorded a mixed performance, with the NSE 20 and the NSE 10 gaining by 0.3% and 0.1% respectively, whilst both the NASI and the NSE 25 declined by 0.3%. This takes a year-to-date performance to gains of 50.6% for the NSE 20, which was on the higher side, and an increase of 45% for the NSE 25, which was on the lower side. The stock market performance was mainly driven by gains recorded by large cap stocks such as Equity Bank, Absa Bank, and Cooperative Bank, which increased by 5.2%, 4.1%, and 1.9% respectively. This performance was, however, weighed down by losses recorded by other large cap stocks such as East African Breweries, NCBA Bank, and Safaricom, which declined by 7.2%, 6.7%, and 0.9% respectively. Up next is our topical issue, and this week we are looking at the launch of ZD Trader, which enables the buying and selling of shares directly from your Mpesa wallet. The landscape of the Nairobi Securities Exchange is about to undergo a massive digital transformation. A new pilot feature within the Mpesa app, dubbed ZD Trader, is set to make investing in the stock market as simple as buying a beer at your local pub. For decades, Kenyans have relied on the traditional model of opening individual accounts with stockbrokers that involves tedious know your customer procedures and long waiting times. Meanwhile, Mpesa, which was previously used for money transfers and payments, has now introduced ZD Trader, which will allow users to buy and sell shares directly from their mobile wallet. The ZD Trader will provide various benefits, including direct access where investors can trade shares via the Mpesa app or by using a USSD code. In addition to that, instead of opening individual share accounts, Mpesa will host what they're calling an omnibus account, which will pool funds together, and these funds will be managed by brokers in the background. The ZD platform will also include tools such as portfolio tracking, watch lists, and price alerts that will help retail traders to make informed decisions. And last but not least, the digital model enhances efficiency by facilitating faster and anonymous trading, which is designed to increase participation by retail investors. The Nairobi Securities Exchange has set itself an ambitious goal of attracting about 9 million retail investors by 2029, and this also includes Kenyans in the diaspora. By replicating the success of mobile bond trading, which was initially introduced in 2017, the exchange aims to improve access to the stock market and to democratize the process of wealth creation. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if that is the case, please share this podcast with your family and friends and help to keep them informed of the latest developments in the financial markets so that they too can make informed investment decisions. Please also consider becoming an active subscriber with a minimum monthly contribution of just $10. And for more information on how to become an active subscriber, please check out our support link at buzzsprout.com/1999543/support. And as always, your support is very much appreciated. And just for your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major distribution channels such as Apple Podcasts, Spotify, and Amazon Music. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address. That is jamhuri@gmail.com. Jamhuri spelled JAMUHURI. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead, and a happy and prosperous 2026. And remember, courage is not the absence of fear, but the ability to take action in spite of the fear. Think about it. Thank you, and God bless.